hopefully it's given you guys some food for thought. But yes, brilliant. Thank you, Helen. Next up, we've got one more duo before we have a little break. The best of the day from the pet accountant. Woo! It's the dreaded talk on tax, which I know-ish. Everyone goes, oh no, it's the accountant. But Lee's got lots of spreadsheets for everybody. But no, today we're going to do a chat on knowing your numbers. Lee's going to do most of it because you're probably bored of seeing my face and hearing me. So I'm going to pass the microphone over to Lee to take it, and I'll just chip in.
Thank you. So each business, I've already ruined it. And breathe. Each business owner should know the critical financial and performance metrics that should be monitored to ensure health, success, and growth of their business. By understanding these figures, you can make informed decisions, identify problems early, and plan for future successes. But what are they? So typically the three most important are your sales, your gross profit, and your net profit. And we're going to drill into a little bit more with these because they're not as simple as they sound. So sales. When we talk about sales, somebody can ask you your turnover, and you might say, well, it's 30,000. But that 30,000 on its own, without context, is that per month, per week, per year? It really has no founding that you can have a little look at and be able to say to somebody, this is how I've got to that figure. So without context, there's little meaning. Context can provide metrics, a way to measure which gives the ability to compare. For instance, how many transactions make up that 30,000? What do those transactions have in common? You could group them together. Types of sales, types of walks, types of grooms, different dog sizes, different products. Now you can see that if one sale type drops, another is increased to pick up the difference. Would a price increase on one allow you to reduce one of the others, lowering the workload, but without compromising on your money, what you earn at the end of the day? How many are one-off bookings? How many are on a repeating schedule? Do you sell more of a particular service on a particular day? Without these metrics, you have no context. Without context, you can't make informed business decisions about future income. So gross profit. Without understanding what makes up the cost of your products or services, you can't employ an effective pricing strategy. The gross profit is your sales less your cost of sales. Now, your cost of sales is a very specific group of expenses. They are any expense that can be directly attributed to the cost of manufacturing or the cost involved in producing one of your products down to an individual unit of sale. For instance, a dog groomer will use shampoo. And whilst a full bottle of shampoo may do many dogs, a business who controls costs will use a set weight, so the quantity is measured and a cost calculated. You can track that weight of shampoo to a specific groom, and so you know how much of the cost of that shampoo is used. Whereas a new pair of scissors, for argument's sake, you may do many grooms without a way to track its value across the grooms, and therefore the scissors is not part of your cost of sales. By knowing your costs to provide your service down to the small consumables, you can maintain your profit margins by increasing your prices accordingly when your suppliers change theirs. You will be able to work out on average what one dog costs you, but down to different sizes of dogs. The healthier the gross profit margin, the easier it is to have enough funds to run your business. So the next side is your net profit. So this is the profit that is yours, the fruits of your hard work. Well, sort of, you still need to pay tax. So your net profit is your gross profit less the rest of your business running costs. The lower your running costs, the higher your net profit margin. Understanding the monthly changes from one month to another can help with controlling costs. Working out your net profit as a percentage of your sales will help you understand how much per pound will be yours on every sale. So if your net profit margin is 30%, you'll make 30 pence in every pound. If 1 month your net profit percentage drops, review those expenses. What caused it? You know, will it happen again? Is this a permanent change? Do I need to increase my prices to maintain my margin? These are the types of questions that you can now ask yourselves because you're understanding the costs that make up those expenses. Set yourself a personal challenge. How high can you get your profit margin, and can you do better next month? Every time that you do that, that's more money in your back pocket. So these 3 metrics alone are not enough to run a successful business. The more metrics you track, the more prepared and reactive you can be to change. Cash flow. So cash flow is very different to profit and loss. A business can run on cash flow without making a profit, and these businesses will generally fail. Continuing in a downward spiral of debt, borrowing from Peter to pay Paul, is one of the worst things a business can do, but becomes more common in businesses where profit is low and becomes a regular survival technique. Cash flow is the measure of money in and out of a business, whatever the source. So money you put in and money you take out does not affect profit, but does change cash flow. Transfers between accounts shows as money in and money out, again without altering profit. This is why we never use cash flow to see if you're at the VAT registration threshold, because if you look at the money in and out, it might inflate what you believe is sales. So effective cash management provides stability to a business. It removes the stress of not having the funds to pay for bills. Everything is planned, and money extracted is affordable without detriment to the business operations. Knowing when things are to be paid and when you can expect money to come in means that things can be timed to your advantage. Creating saving pots to help save for larger monthly bills, or save for tax by dividing the payments that you arrive into your account on a daily basis and distribute them to pots. A key behavior if your business is to be VAT registered. Your break-even points. So the break-even point, now this is the magical number where your hard work becomes pure profit. By taking your total costs of the business and dividing it by the working days, gives you a minimum financial target to make each day. Once you hit this number, every product that you sell or service you deliver from that point forward is profit. Some people choose a weekly break-even point, others monthly. Breaking it down into manageable chunks makes it easier to see the rewards of your drive. I prefer daily. I find it drives me more to achieve. If I fail one day, I try harder the next. But don't rest on your laurels, knowing you've achieved it yesterday so that it means that you can take your foot off the gas today. Treat every day as a clean slate and review why you didn't reach it and make changes to make sure that you do tomorrow. Your break-even point will change as your business costs and income evolve, so regularly reviewing your break-even point is essential. The dreaded VAT. So keeping a close eye on your sales figures can help with VAT in many ways. Firstly, you need to know when you're at the VAT registration threshold. This is your turnover, not profit, and it's when it reaches £90,000 in a rolling 12-month period, not just between April and April. Well, yeah. Yes. So by checking the rolling 12-month turnover at the end of every month, you will make sure you don't miss the registration window. Once registered, if you're on the flat rate VAT scheme, you can predict your VAT by knowing what your anticipated sales will be. You can then manage cash flow to help save for the VAT bill, knowing what % of the income into your bank you need to put into a pot. Understanding when your VAT bill is due will help focus your drive to ensure the money is there to pay the bill. Getting into the right mindset that you are a tax collector now for HMRC, and that separating out the VAT money which belongs to HMRC and not yourself will make it easier if you already think it's not your money. Becoming VAT registered removes the glass ceiling holding some businesses back. Embracing it and tackling it head on with a strong business and a strong understanding of your finances means that it will become manageable, and having the right software and accountant will help. Just saying, we're the accountants that you need. So, putting value on expenditure. Make your money work. Almost all things within a business can be monitored and metrics can be designed to allow comparison. It's what you do with that data that counts. Understanding your expenses and what they are doing for your business is critical for healthy profit margins. Not only do they aid profit, but also growth. Some expenses are investments. For instance, advertising costs. Where are you advertising? How many leads is each one providing? And what are the quality of those leads? What's the number of conversions? And what's the cost of each? These are all of the types of questions that you can be asking yourselves to find out whether this investment is a true investment or if it's just money down the drain. So understanding where your business leads are coming from is critical, but you need to dive deeper. For instance, consider a business spending £300 a month on Bark. Okay, for those of you that don't know what Bark is a lead provider that will provide you with cold leads of clients looking for your services potentially. If it's providing 100 leads a month, so that's £3 a lead, but what if only 5 people say yes to your services? So those 5 people is actually costing you £60 each because you had to buy 100 leads to be able to convert those 6. Now, if you were spending £100 more on Google, for argument's sake, and you're spending £400, but Google was only giving you 30 leads, so they're substantially less, which means they're costing you a lot more at £13.33 each. But if 9 of those say yes, that costs you just £44 of the cost of acquisition. On the surface, Google costs you more, but by drilling down into the metrics, Google is saving you £15 plus per client acquisition, because whilst Bark was giving you higher numbers, they were of a lower quality, and you needed more of them to make the same money that Google is. So spend smart, make your money work for you, and know what you're getting for it, and work out ways to measure its success. Redistribute your resources to help within the business. In quieter times, look at what advertising outlets provide the best return on investment, the lowest client acquisition cost, and the quickest return, and then funnel more money into that. Staff costs. Are you overstaffed, understaffed? How much idle time is there? Can hours be reduced or redirected? And are service levels impacted? Knowing the numbers of dogs groomed per period of wages can work out how much revenue a member of staff on average will generate. Client retention. How many new clients have you gained over a period? How many have you lost? What's the value of each? Does net lifetime value of the client exceeds the one that you have lost? Why are you losing them? Group them into reasons and address the main issue. Track the ratio. For every 3 clients you gain and you lose 1, that's a client ratio of 3 to 1. Monitor your ratios. These are all things, little things that can be done that will give you a quantity and data that you can work with that will allow you to make changes, meaningful changes within your business. Equipment purchase and replacement. Monitor how often you repair or replace an item. Does it need replaced? Would a more expensive one last longer? Can an alternative be used? Spending more could save you more in the long run, where a cheaper product requires replacement more often. So drive profitability, okay? So mastering your metrics can give you significant advantages. Empowered decision making. Numbers provide objective data to guide decisions on pricing, investment, which products and services to focus on, and ultimately what money you can earn. Informed strategic planning. By understanding your sales, your losses, overheads, and supplier-driven costs, you can use these trends to forecast based on your actual data. You can set realistic goals and prepare for future challenges. Is it time for a price increase? Increased credibility. Showing potential investors or lending facilities that you have a solid grasp on your finances builds confidence and improves your chances of securing funding. Higher profitability. By identifying profitable areas, cutting costs in underperforming ones, and redirecting resources can improve your overall profitability and improve cash flow. Small incremental cost pressures can really impact your margins. Regularly review your metrics. Look at how they compare to last week, month, year, and make swift decisions to stem any loss or capitalize on the ones that are heading in a positive direction. That's that for that. So Vicky, would you like to come and do MTD?
It's his first public speak, everyone. Give him a big hand. Bless his little heart. So obviously we know that the lovely Rachel in a few weeks is going to be doing her speech, and I know that's going to affect everyone. So please check out our podcast, because we will do an update on that and how that affects everybody. We'll not get into it now, because then we'll all get angry. Just a quick, and it might change. Just a show of hands, who has heard of Making Tax Digital? Fabulous. Keep those hands up. Keep them up if you know what it actually means and what you actually have to do with it. A few have gone down. So I'm not going to keep you long. You can put your hands down, you're fine. Making Tax Digital, basically, in its simplest form, is that a lot of people here might use spreadsheets, they might use our record-keeping pack, they might use a diary, bits of paper, grid paper, Kelly, grid paper sellotaped into a massive treasure map on some occasions. True story. But we can't use that anymore. As of April next year, you have to be on software. And by software, we mean Xero, Free Agent, Dext. Everyone knows who knows us, we call it shitbooks. It's just a personal preference. If you do use it, it's absolutely fine. But we have to use that software. So they are doing it in stages, so don't panic if you sat there thinking, shit, I like my spreadsheet. If you have a turnover of 50,000 or more, you will have to go digital from April next year. No if, buts, or maybes. You have to do it, so you have to get on the software, and everything has to be done through that software. April 27 is 30 grand or more, and then I'm assuming, we don't know yet, but April 29 will keep going, and eventually the idea is that everybody will be using accountancy software. I know there's technophobes out there like me, but unfortunately this is the government's plan. They want to make everything more efficient, so we have to go on software. But there are stages. Limited companies and partnerships haven't come out yet, so we don't know the date. A few, yes! Unfortunately, sole traders, it does include landlord or landlady income. So if you do have a flat or house that you rent out, then it is included in that as well. So it's 50 grand or more next year, then 30, and then so on. Just to add to that, to add to people's pain, at the minute we do one tax return that has to be in by the 31st of January. When this Making Tax Digital starts, we have to do 5. I know, everyone's like, shit. So every quarter, you will have to submit a quarterly submission to HMRC, which includes your turnover and your expenses, which is why it has to go through the software. So every 3 months, like a VAT return, you have to submit a quarterly submission to HMRC. So you have to do that 4 times, and at the end, you have what's called a final declaration, which is kind of similar to the tax return, but then you have to submit that at the end. So there's 5 things to submit. And in a true HMRC fashion, if you get it late, points mean penalties, which means fines. So they're going to move to a point-based system. So if you keep being late, you'll get more points, which will equate to more money and more fines. So sorry to put a downer on the day. But if you're earning under 50 grand, you're fine. But those who are for this year, 50 grand or more starts next year, and then every year it will roll out, and you have to do 5. Go on.
So you have to do quarterly submissions. Do you have to pay quarterly now then? Okay.
Not yet. Not yet.
But that is probably the way that we're heading. The payments on account and your deadline for paying will remain the same. The 4 submissions, or the 5 submissions that Vicky originally talked about, is 4 during the tax year. So that's 1 every quarter, which includes your income and your sales. So it's really important that you're not mixing things in that submission, like your drawings, for argument's sake. People may put those down as wages if you're a sole trader, and that reduces your expenses, increases your expenses or reduces your profits. But that's not an allowable expense to a sole trader, so you need to make sure you don't put those things in. So these submissions can have some errors, but then what's replacing the tax return on the 5th submission, which would be due before the 31st of January like normal, is that any correcting adjustments can be done in that 5th submission. But that 5th submission might be already like 2 or 3 in after you've started the following year's submission. So it's going to get quite complex. So there are things that are out there that's helping people. Certainly like Free Agent's got good software. Xero's got the software. We've got guys on standby as well waiting for clients to come on board that want us to do the submissions for them. If you've got Dext is able to do the submissions as well. So there are things already that's in place, and like we're gearing up because we know that we're going to have an influx of people coming to us because it is going to be a nightmare. It's just like that basically is every quarter.
And I would check software that you use, because some people do have some weird and wonderful softwares that we've not heard of. You've got to check that they're MTD compliant, because if they're not, they won't work. So even us as accountants, we submit our tax returns at the minute through a certain system. Even we can't do that. It all has to go through the software. So you need a really, really good software that you're comfortable with, because if you're doing your own bookkeeping, you've got to make sure you're getting it right, because you've got to submit it every 3 months. So, yeah, sorry if we've just put it down.
And bear in mind, some of this software might be MTD compatible, but they won't give you the reports to know your figures. So you won't be able to run things and to have a look at what you've spent on expenses. So just bear that in mind as well. So some of the banking apps are offering a MTD compatible, but then Metal has an integration with Free Agent. So in my mind, why would you submit it through Metal if we can connect it to Free Agent and have all of the reports that we need and see what we've submitted? So, and then it's easier to do the corrections if there's anything wrong when we do the 5th submission.
Will submitting it more regularly keep your sort of tax payments more up to date in terms of if you were to have like a significant increase in the year?
No.
No.
So it's your 5th magical submission, because the 4 that you do during the year ignores anything else that you have going on in your life. Now, the way that a self-assessment works is that it's collating your worldly income and taxing you on that income. The 4 submissions that you do just looks at your sole trade income and your landlord income. When we do the 5th submission, we then take into account capital gains and anything else that you may need to pay tax on, or anything else that we can get reliefs from. So it's only on that 5th submission will HMRC know how much money that you actually need to pay, which is no different to the self-assessment system at the moment.
It's more a system to help the government understand how much tax they're going to get off you guys throughout the year, rather than them having to wait until the 31st of January and go, oh, we've got £10 million worth of tax coming in. It's so that they can plan, but it's to make us more efficient.
Changes the quarterly, are we going to have to pay quarterly? And you'd said no. HRMC have actually, they did that to me this year. I always make the payment by the end of 31st of January. Well, this year on my HRMC app, they had put that I had to pay a certain amount by July, and I ignored it, thinking, well, it's fine, I can pay by the end of January. And I already got the letters come through saying you're late with payments, and they'd added more on. So what's that?
That's payment on account.
Why have I never done that before?
We'll talk privately. But that's payment on account, slightly different.
I'll answer it very quickly, but not specific to you.
Yeah.
So payment on account is when you get to the end of the year, and if your tax bill is over £1,000, you have to pay 50% of that up front again for the following year. So if my tax bill this year is £1,000, my first payment on account will be in January. So the first one's going to be in January, and it'll be £500 plus the 1,000 I owe, so it's 1,500 quid. When I get to July, I've got to pay the other £500 again, so that when we get to the following January, it's the balancing payment, which is the difference between the tax that I've now calculated, less the 2 payments I've made. I'll hand HMRC the difference over, and then they'll go, right, now we want 50% up front again, ready for next year. So you're paying in advance of tax. Yes.
But it does take a while.
After an argument.
Yeah, we should give them a point system and go, right.
I've had a client that's been waiting 6 months for a VAT rebate. So it really does depend on which department and who you get and how long they take. Right, yeah, I'll run up here.
Come on, Alicia.
So is it going to be the same deadline as the VAT? Like the tax returns quarterly?
No, because your VAT you can pick the quarter that you want the VAT return to be in. So that will be different for everybody. If you're one of our clients, we will align the VAT with the tax year because it makes sense. However, your VAT quarter could end on any one of those 12 months. HMRC will run the same quarters for everybody as part of MTD, which could be different to your VAT. And if you're a limited company, again, it doesn't apply to those, so you don't have to worry about that side of things. All right?
Just to confuse you. Oh, I'm getting told off.
When we do it every 3 months,
Hey.
how long have you got? Like, so if it's if we're doing it in April,
I think they're giving you a month. Yeah, 30 days
Okay.
to send it. It's not going to be like an immediate day after. There will be like time period. I'm getting told off, so we'll have to go. But
One last one.
go on, one more.
You say that it doesn't affect limited companies.
Not at the minute.
Yeah.
Limited companies is coming later, so is partnerships. But this was meant to be in like 4 years ago, but because of COVID, they've delayed it. But it's definitely coming in. Right, we're going to wrap up. We've got a 10-minute break. Sorry, we've got a 5-minute break to go and have a wee. And then we've got a brilliant seminar up next on money mindset, which is my favourite. So make sure that you are back here in 5 minutes.